For generations, gold occupied a unique place in the global financial system. Governments fought trade wars. Currencies rose and collapsed. Empires borrowed, defaulted, and rebuilt. Yet through every major economic shift, one assumption remained remarkably consistent: physical gold moved across borders with a level of neutrality that few other assets enjoyed. That assumption may now be changing. A recent U.S. customs decision involving specific categories of imported gold bars has sparked intense debate across financial markets. Within hours, investors, traders, and institutions began asking the same question: has America quietly changed one of the oldest rules in global finance? What surprised markets even more was the reaction. Gold didn't weaken. It climbed. At first glance, that seems backward. Most people assume that adding costs or restrictions to an asset should reduce demand. Instead, the opposite happened. Why? According to the way many institutional investors think, including ideas often emphasized by Jamie Dimon about market structure, liquidity, confidence, and long-term capital flows, the answer has very little to do with gold itself. It has everything to do with trust. Because financial markets don't simply price today's reality. They price tomorrow's uncertainty. And uncertainty is exactly what this event introduced. Today, we're going beyond the headlines. We'll explore why a seemingly technical customs decision captured Wall Street's attention, why central banks have been accumulating physical gold for years, how institutional investors interpret moments like this, and why the distinction between owning a claim on gold and owning physical metal has suddenly become far more important than many investors realized. Stay with me until the end, because this story isn't just about gold. It's about how the global financial system may be entering a new phase, and what that could mean for anyone trying to preserve wealth in an increasingly uncertain world. Before we continue, I'd like to hear from you. Where are you watching from today? And if you're comfortable sharing, which asset gives you the most confidence during uncertain times? Gold? Silver? Cash? Stocks? Real estate? Leave your answer in the comments. It's always fascinating to see how investors around the world think differently about protecting their savings. The quiet shift nobody expected. Most market-moving events arrive with headlines. Interest rate decisions. Inflation reports. Employment numbers. Corporate earnings. But occasionally, the events that matter most begin with documents that almost nobody reads. That's what makes this story so unusual. Rather than a dramatic announcement, the discussion began with customs classifications affecting certain imported gold bars, the very bars commonly used throughout the professional bullion market. To many people, it sounded like little more than bureaucratic paperwork. To institutional traders, it sounded very different. Because markets rarely react to paperwork. They react to what paperwork changes. The moment investors realized these classifications could increase costs or alter the movement of physical gold into the United States, attention shifted almost instantly from policy to supply. Not because gold had suddenly become rare, but because moving it efficiently had become more complicated. And in financial markets, complexity often creates premiums. Jamie Dimon's way of looking at markets. Jamie Dimon has spent decades discussing a principle that extends far beyond banking. Markets function best when confidence is abundant. When confidence declines, investors don't simply reassess one investment. They reassess everything. Liquidity, credit, counterparty risk, supply chains, capital allocation. Every major financial disruption follows this pattern. The surface event changes. The underlying psychology does not. When uncertainty increases, markets begin asking entirely new questions. Can this asset still move freely? Can institutions obtain enough supply? Will financing become more expensive? Will market participants change their behavior? These questions often matter far more than the event itself, because expectations shape prices long before reality catches up. That's one reason why markets sometimes move dramatically before the broader public fully understands what happened. Professionals aren't reacting only to today's facts. They're imagining tomorrow's possibilities. Gold has always been different. Unlike most commodities, gold serves two very different purposes simultaneously. It is a physical asset, and it is a financial asset. Oil gets consumed. Copper gets manufactured. Corn gets eaten. Gold behaves differently. Much of the gold ever mined throughout history still exists. Stored, protected, transferred, accumulated, waiting. That makes confidence extraordinarily important. The value of gold isn't determined only by industrial demand. It is deeply connected to how people feel about currencies, governments, inflation, debt, and financial stability. Whenever confidence weakens elsewhere, confidence in gold often strengthens. Not always, but often enough that history continues repeating the same lesson. Gold isn't merely purchased because people expect prosperity. It is frequently purchased because they expect uncertainty. Why physical gold suddenly became the conversation. One of the most misunderstood aspects of modern investing is the difference between exposure and possession. Millions of investors believe they own gold. Some do. Some own shares linked to gold. Some own futures contracts. Some own exchange-traded funds. Others own mining companies. Each offers different characteristics. But institutional investors increasingly ask another question. Where is the actual metal? That question sounds surprisingly simple. Yet during periods of market stress, it becomes incredibly important. Imagine two investors. One owns physical bullion stored securely. Another owns financial exposure designed to track the same price. During normal markets, the difference may appear insignificant. During disruptions involving transportation, settlement, tariffs, or supply chains, those differences can suddenly matter much more. Not because one investment automatically becomes superior, but because market mechanics change. And when mechanics change, pricing changes. Institutional investors understand this well. Retail investors often discover it only after volatility arrives. Markets don't fear change, they fear uncertainty. This is where psychology becomes fascinating. Most investors think markets dislike bad news. That's only partly true. Markets dislike uncertainty even more. Bad news can eventually be measured, priced, analyzed. Uncertainty cannot. When investors cannot confidently estimate future costs, future availability, or future policy decisions, they demand larger safety margins. That behavior influences everything. Government bonds, currencies, commodities, equities, and especially gold, because gold has always represented something larger than itself. It represents optionality, the ability to preserve purchasing power when confidence elsewhere begins to fade. Today's discussion about tariffs isn't simply about taxation. It's about whether the rules surrounding one of the world's oldest monetary assets are becoming less predictable. And history suggests markets pay very close attention whenever predictability begins disappearing. One of the biggest mistakes investors make is believing that markets move because of news. They don't. News may start the conversation, but markets move because of expectations. And expectations are shaped by one question that every institutional investor asks before everyone else. What changes next? That question explains why a single policy decision can move billions of dollars before most people have even finished reading the headline. Jamie Dimon has often emphasized that financial markets are ultimately built on confidence. Banks lend because they expect borrowers to repay. Businesses invest because they expect customers to spend. Investors buy assets because they believe someone else will value them tomorrow. Confidence is the invisible currency beneath every visible market. When confidence changes, prices follow. And that is why the recent discussion surrounding imported gold bars attracted so much attention. The issue was never simply whether a tariff might increase costs. The larger question was whether it represented another step toward a world where capital, goods, and even monetary assets move less freely than they did for decades. For institutional investors, that possibility matters enormously. Because once markets begin adapting to a new reality, capital starts moving long before the headlines catch up. While television debates focus on daily price movements, another group of buyers has been quietly making decisions that rarely generate breaking news. Central banks. Unlike hedge funds, they don't chase quarterly performance. Unlike retail investors, they aren't trying to outperform the market next month. Their job is much simpler. Protect national financial stability. And for years, many central banks have steadily increased their gold reserves. Why? Not because they expect gold to outperform every asset every year, but because gold performs a role that very few assets can. It carries no promise from another government, no corporation, no bank, no CEO, no earnings report, no quarterly guidance. Its value doesn't depend on someone else's ability to repay debt. That independence has become increasingly valuable in a world where geopolitical tensions continue to reshape international trade. Institutional investors notice these patterns. When central banks accumulate an asset consistently over many years, professionals don't simply ask what they're buying. They ask why. That question often reveals far more than the purchases themselves. History rarely repeats perfectly, but it often rhymes. Financial history teaches one lesson over and over again. Every generation believes its system is permanent. Every generation eventually discovers it isn't. There was a time when the British pound dominated international finance. Then the world changed. There was a time when fixed exchange rates seemed immovable. Then they disappeared. There was a time when globalization appeared unstoppable. Today, many economists debate whether that era is slowly giving way to something different. More regional supply chains. More strategic industries. More economic competition. More national security considerations. More tariffs. More industrial policy. Whether these changes ultimately prove temporary or permanent remains uncertain. But markets don't wait for certainty. They adapt while uncertainty still exists. And that adaptation often begins with assets considered stores of value. Gold sits near the top of that list. The difference between owning gold and accessing gold. This distinction is subtle, yet it may become one of the defining investment questions of the coming decade. Many investors believe all forms of gold ownership are essentially identical. They're not. Imagine visiting a library. You borrow a rare book. You have the right to read it, but you don't actually own it. Now imagine owning the only printed copy yourself. Both situations provide access. Only one provides possession. Financial markets often operate in much the same way. Some investors own physical bullion. Others own financial instruments linked to bullion. Both may benefit from rising prices. But under unusual market conditions, those experiences can differ. Transportation constraints, settlement delays, higher premiums, regional shortages, policy changes. These factors don't always matter. Until suddenly they do. Institutional investors spend enormous amounts of time studying these possibilities, not because they expect them every year, but because the cost of ignoring low-probability risks can become extraordinarily high. Jamie Dimon has repeatedly warned that resilience matters just as much as returns. Preparing for uncertainty is often more valuable than trying to predict it perfectly. The psychology behind market surprises. Human beings have a fascinating tendency. We assume tomorrow will resemble yesterday. Psychologists call this normalcy bias. If something has worked smoothly throughout our lives, we subconsciously treat it as permanent. Electricity, internet access, banking systems, supply chains, global trade, financial markets, gold transportation, until something interrupts them. Then suddenly everyone begins discussing risks that were almost invisible only days earlier. This pattern appears repeatedly throughout economic history. Before the global financial crisis, many believed housing prices couldn't decline nationally. Before supply chain disruptions, few imagined everyday goods becoming difficult to obtain. Before regional banking stress, many assumed deposits were something nobody ever questioned. Markets constantly remind us that confidence is strongest immediately before uncertainty arrives. That's why professional investors spend so much time asking uncomfortable questions. Not because they expect disaster, but because resilience begins before disruption, not after it. Retail investors often focus on price. Institutional investors focus on liquidity, the ability to buy, the ability to sell, the ability to settle transactions efficiently. Liquidity is what allows enormous financial systems to function smoothly. When liquidity becomes more expensive or more difficult, volatility often increases. Gold has historically enjoyed exceptionally deep global liquidity. Large bullion markets, international vaults, refineries, shipping networks, professional dealers. But whenever barriers begin affecting the movement of physical metal, markets naturally start reassessing liquidity. Again, this doesn't automatically imply crisis. It simply changes calculations. And markets constantly reprice changing calculations. That's why sophisticated investors paid such close attention. The discussion wasn't only about tariffs. It was about whether market structure itself had begun shifting. Why Wall Street watches small details. To most people, customs classifications sound incredibly boring. Yet financial history repeatedly shows that some of the biggest market moves begin with technical details that almost nobody outside the industry notices. A change in collateral rules. A regulatory adjustment. A settlement requirement. A capital ratio. A customs classification. Each appears insignificant in isolation. Collectively, they influence trillions of dollars. Jamie Dimon has frequently spoken about understanding systems rather than headlines. Because systems determine outcomes. Headlines simply describe them afterward. Professional investors spend less time reacting. They spend more time preparing. That difference explains why institutional money often moves before retail investors recognize why markets are changing. A bigger question than gold. Perhaps the most important lesson isn't about precious metals at all. It's about the direction of the global economy. For decades, businesses optimized for efficiency, produce wherever costs were lowest, ship wherever demand was highest. Capital moved with remarkable freedom. Today, resilience has become just as important as efficiency. Governments increasingly discuss strategic industries, supply chain security, domestic manufacturing, critical minerals, economic independence. These priorities influence far more than industrial policy. They reshape investment decisions. And whenever governments redraw economic priorities, financial markets begin repricing risk. Gold simply happens to be one of the first assets where those changing priorities become visible. As this story continues unfolding, one question becomes increasingly difficult to ignore. If the rules governing one of the world's oldest stores of value are evolving, what other assumptions might investors need to reconsider? That question leads directly into the next chapter. Because understanding where institutional money goes next may matter even more than understanding what happened today. There is an old saying on Wall Street: markets don't ring a bell before they change. The biggest shifts in financial history rarely announce themselves with certainty. They begin quietly, with policy changes, subtle signals, and decisions that seem technical until, looking back years later, everyone realizes they mark the beginning of something much larger. Whether this tariff ultimately proves temporary, narrowly applied, or becomes part of a broader trend, it has already accomplished one important thing. It forced investors to ask questions they hadn't been asking before. And sometimes, asking the right question is more valuable than immediately finding the answer. The three roads ahead. No one knows exactly how the global gold market will evolve from here. Anyone claiming certainty is selling confidence they don't possess. But investors can think in probabilities instead of predictions. Let's consider three possible paths. In the first scenario, policymakers clarify the rules, supply chains adapt, and the market gradually absorbs the additional costs. Price differences between regions narrow, physical premiums stabilize, global bullion flows normalize. If that happens, this event may ultimately become another example of markets adjusting efficiently to new conditions. History contains many such episodes. Markets are remarkably good at adapting. The second possibility is more significant. Instead of quickly returning to normal, regional differences begin lasting much longer. Gold inside one market consistently trades at different premiums than gold elsewhere. Transportation costs rise. Storage location becomes increasingly important. Institutional investors pay closer attention to where bullion is held rather than simply how much exists. In that world, geography begins influencing valuation in ways many investors have never experienced. Gold remains gold, but location becomes part of the investment equation. The third scenario extends beyond precious metals. If more countries continue emphasizing domestic production, strategic reserves, and economic security, global capital could gradually become less frictionless than it has been during much of the past for decades. That wouldn't necessarily mean globalization disappears. It would mean globalization evolves. Supply chains become more regional. Strategic assets become more closely watched. National resilience becomes a larger priority. Gold would simply be one reflection of that larger transformation. And history suggests that whenever financial systems evolve, investors who understand structural changes early often make calmer, more disciplined decisions than those reacting only to headlines, the lesson hidden beneath the price. When most people see gold rising, they immediately ask, "Should I buy?" Professional investors usually ask a different question. Why did the market respond this way? Those are very different conversations. Price tells you what happened. Understanding tells you why. And understanding lasts much longer than any single market move. This is one reason experienced investors spend so much time studying incentives, policy, and psychology rather than simply memorizing price charts. Markets are driven by people. People are driven by expectations. Expectations are driven by confidence. Everything eventually circles back to confidence. Preparing instead of predicting. One principle has survived nearly every financial cycle. Preparation consistently outperforms panic. The investors who preserve wealth over decades aren't usually the ones making dramatic moves every week. They're the ones who build resilient portfolios before uncertainty becomes obvious. That doesn't mean abandoning diversification. It doesn't mean concentrating everything into one asset. And it certainly doesn't mean reacting emotionally to every headline. It means understanding the purpose each investment serves. Stocks for long-term growth, bonds for income and stability, cash for flexibility, real assets for diversification. gold, for many investors, as one potential form of financial insurance rather than a guarantee of profits. Each serves a different role. Confusing those roles often leads to disappointment. Understanding them builds resilience. A question worth asking yourself. Imagine looking back 5 years from now, not knowing whether gold ultimately rises, falls, or moves sideways. Instead, ask yourself another question. Will the world become more predictable? Or less? Will geopolitical competition disappear? Will government debt suddenly shrink? Will inflation risks permanently vanish? Will supply chains become simpler? No one can answer those questions with certainty, but the answers matter far more than tomorrow morning's gold price. Because long-term investing has never been about perfectly predicting the next headline. It's about preparing for multiple possible futures. Why institutional investors think differently. Large institutions rarely build portfolios around certainty. They build around uncertainty. Insurance companies, sovereign wealth funds, pension funds, central banks. Their objective isn't maximizing excitement. It's maximizing durability. That's an important distinction. They know unexpected events eventually arrive. The exact event is rarely predictable. The existence of uncertainty always is. That's why diversification remains one of the oldest principles in investing. Not because every asset performs well every year, but because nobody knows which asset will matter most during the next unexpected chapter. The real story was never just gold. Perhaps the biggest misunderstanding surrounding this entire event is believing it's only about precious metals. It isn't. It's about confidence. It's about policy. It's about global trade. It's about market structure. It's about how investors respond when long-standing assumptions begin changing. Gold simply became the mirror reflecting those larger questions. Throughout history, every major financial transition has taught the same lesson. The asset attracting headlines isn't always the real story. The changing system behind it usually is. Let's return to where we began. For decades, many investors assumed physical gold would always move across borders under largely predictable rules. Today, that assumption faces new questions. Whether those questions ultimately reshape global markets remains to be seen. But they have already reminded investors of something remarkably important. Financial systems evolve, rules change, markets adapt, and successful investors adapt with them, not through panic, but through understanding. If there is one lesson worth remembering from this entire story, it is this. The greatest investment advantage rarely comes from knowing tomorrow's price. It comes from understanding today's direction. Because prices fluctuate, headlines disappear, political cycles come and go. But the investors who consistently preserve wealth across generations are often those who remain curious, disciplined, and prepared while others become emotional. So, as you watch this story continue to unfold, don't ask only whether gold rises or falls. Ask what the market is trying to tell you. Sometimes, the most valuable signal isn't the move itself. It's the reason behind the move. And understanding the difference may prove far more valuable than any prediction. If you found this breakdown valuable, consider subscribing for more deep dives into macroeconomics, precious metals, central bank policy, and long-term wealth preservation. And before you go, leave a comment below. Do you think this marks the beginning of a more fragmented global financial system, or is the market overreacting to a temporary policy shift? Because the most interesting conversations aren't about today's price. They're about tomorrow's world.